Joining us now, Stephanie Link, Chief Investment Strategist, Portfolio Manager at Hightower Advisors, as well as a CNBC contributor. And I've learned not to ask you what the market's going to do near term. And with you, you're managing money, so it has to do with individual names, and it doesn't really matter what the overall market's doing. But would you be more cautious based on the number yesterday, or simply based on the PPI, or simply based on the August-September seasonal sort of trend?
Yeah, I mean, I think that August and September typically are the weakest months of the year. If you go back 10 years, August is about flat. September is down about 2%. But by the way, October, which gets kind of the bad reputation, on average, it's up 2%. So you do want to be buying into the volatility. We might get volatility retail sales later today. We get Jackson Hole next week. We get inflation numbers again before the meeting. But at the end of the day, I mean, the economy is growing at 2.5%. Earnings have come in much better than expected, led by margins, which has been something that I've been expecting. So, yeah, so on the volatility, Joe, I think you do want to be buying, because I think once we get through this volatile period, the fourth quarter setup is going to be a good one. Typically, it's seasonally the strongest of the year. And I think you're still getting a lot of companies on sale. Maybe not tech, but other parts of the market are actually still pretty attractive.
Well, even though you're loath to jump into the political backdrop, if you really thought tariffs were going to be a really negative thing for the U.S. economy, I don't think you would have said what you just said.
Right. Well, look, I mean, we have tariffs, and CPI was, high, elevated, sticky, but you're making progress on shelter, which is 34% of CPI. PPI, obviously not a good number yesterday, very sticky, but a lot of that was portfolio management fees up 5.8%. And maybe the trade services strength, maybe that's a one-time thing or two-time thing. So I think what was interesting, Joe, is after the numbers this week, the probability of the Fed still cutting 25 basis points in September is still 94%. So I think that the tone of Powell next week will be key, and that could create some volatility. But I think we do want to be buying that because, by the way, in the face of all of this, weekly jobless claims actually came in, again, really good. You're running at about 221,000 on a four-week moving average. So the labor market is still pretty good.
Yeah, Rick mentioned that. We do... I don't know whether it's what we do for a living or what, but we go from, oh, my God, tariffs, the end of the world, tariffs, to, oh, my God, tariffs haven't done anything. We're waiting for inflation. It's never going to be a negative. We're there for, a month. Now we're back to, oh, my God, tariffs are the end of the world for inflation. It's never like sort of just, reasonable, or maybe, somewhere in the middle.
We're always extreme, of course, right? But I think what gets misplaced is the reason that why are we doing tariffs to begin with? I mean, we're generating revenue. I know it's at a cost. I understand that. But we're also bringing more jobs back here, more manufacturing back here. That's why the onshoring and reshoring theme has been so powerful. And that's why, okay, we understand the NVIDIA story and the Broadcom story, but the industrial companies that have exposure to data center and grid and power, those stocks have all done so amazingly well. They've actually pulled back a little bit as of late. I think there are your opportunities, too.
Yeah, you're right, though. It's like... It's a tax. It's a tax. It's a tax.
Yeah.
From people who love taxes. You want to go to 28% on the corporate tax rate. Now you don't like it. You found a tax you don't like. I'm not talking about you.
I know.
Calm down. But you know the people I'm talking about. That they've never met a tax they didn't like until Trump puts a tariff on, and then it's a tax they don't like. Because it really is a tax, and it might be. The only thing you can say, Andrew,
is
it's
a regressive tax.
Okay, maybe it's
a regressive tax. Look, I'm not making the point one way or the other. I'm just saying that's what it is.
I know that's what you fall back.
It's not a fallback. It's the factual.
Because it gets passed, may get past the consumers. Right. Okay, I understand that. But normally, taxes. I mean, rub them all over my. I mean, I sleep.
No, there's no question that Democrats. Especially the most liberal among the Democrats would like higher corporate taxes.
And why isn't that regressive?
Why isn't that regressive? That's actually a good and smart question.
I know. Thanks.
There you go.
I try.
And I'm giving you some credit, my friend.
All right. Well, I'm telling you that's the knee-jerk is the regressive thing, because that gets you out of admitting that Democrats love taxes but hate tariffs when it's the same thing, basically.
It's not really the same thing.
Might be better.
Maybe it's better, by the way.
Might be better.
Maybe it's better.
Because we're accomplishing something.
But then you know what?
Yeah.
Then the administration and the government should say, the reason we are doing these tariffs is because we're trying to raise revenue, and we're trying to, this is a form of a tax, and let's just say what it is.
But they're not going to say it. But there is.
But they're not going to say it.
There is some truth, and we saw yesterday that there is some truth that some of the foreign exporters are eating some of this because they don't want to lose the market share, and that's money we're getting. You could connect the dots and say we're getting money from them.
The one thing that I don't think people fully appreciate.
Poor Steph.
Sorry, Steph. There's one thing.
Like a tennis match.
That's okay.
Steph, I think there's a view among some, and I think it's a wrong view, that somehow these tariffs are temporary or may be here for a couple of years during the Trump administration, may not be here in the future. It seems to me that this is a new state of permanence that's going to last almost at minimum at least a decade or two. Because the
Democratic administration.
Well, because here's the
you're just assuming JD is going to be president.
No. What I'm assuming is once you raise, call it $300 billion a year, and that's built into the budget.
You might like that.
It is it's very hard to turn around and say, actually,
Biden couldn't do it.
No. We don't want that money.
Biden couldn't.
And so by default, there's a permanence about this, which, by the way, I think therefore has a permanence to the sort of geopolitical situation, our relationship with others. That's what when I'm saying that this is a real shift, like a long-term generational shift. It may be happening in this moment, and you're saying, oh, it's just a moment. I'm saying this is like I don't want to say forever. Nothing's forever, but it's long-term. That's the point.
But Andrew, everyone has been complaining about the deficits, the debt. And if you could actually chip away and get $300 billion a year, that's a positive over the longer term. And I think if you have better than expected
I'm not saying it isn't.
Because beyond tariffs, but wait, beyond tariffs, you get past tariffs and you have deregulation and you've got the tax situation that we all know. They're staying low. They're not lower, but they're staying low. You have CapEx and a huge CapEx cycle that we have not seen in over a decade. You add it all up. That's actually positive. The tariffs are not positive on the consumer. I get it. I understand. But there are some positives that we have to consider. And that is what the market is telling us. And you have to look at the market. It's a forward-looking indicator.